Good evening. My name is Joe Scarice, co-founder and co-host of the Real Estate Mastermind Strategies. I'd like to thank you for tuning in to us this evening here at TCS Property Management offices up in the penthouse down at 2nd and Chestnut. We provide an educational event here every second Monday evening of the month, 6:30 p.m. Get done around 8:30 p.m. We try to bring in different pieces of the pie for education, real estate, for real estate investors. We also provide this information through our website at creativeburststrategies.com, where we provide a weekly update of education and update to news trends and market trends every Sunday morning, 9 a.m. Eastern Standard Time. You can find all this information either at josephvscarice.com at the events link and or creativeburststrategies.com at the events link. So tonight we have a great special guest, another great subject to discuss. We have Mark Baran with NL1031, the founder. And thanks for coming out. And I found out that we're fellow North Jersey guys, so
That's
I think
right.
this is we can get a little Jersey slang going on here.
Exactly.
But love to get a little background on yourself and any disclaimers that we need to provide for everyone listening in tonight.
Great. Thanks, Joe. Thanks for inviting me. Great to see everybody tonight. And just before I get started, I just want to make a disclosure, as Joe said. I am a registered representative with McDermott Investment Services, which is a broker-dealer based in Bethlehem, Pennsylvania, and Naples, Florida. And just want to say, if I can read this to begin with, what I'll be saying this evening is purely informational. This is neither an offer to sell or solicitation to buy a security, which can be made only to prospective investors if it's preceded or accompanied by a private placement memorandum, which contains the various important risk disclosures. The material does not purport to be complete, should be read in conjunction with a memorandum. All potential investors read the memorandum, and no person may invest without acknowledging that they have received, read, and fully understand the memorandum. So now that the legalese is out of the way, I'll be just talking in generalities about 1031s and how they work. And I work with real estate investors. I've been in the business for quite a long time. Both real estate, securities, investment management, private equity, and work with real estate investors all over the country. Also, their advisors, their accountants, their tax attorneys, and a number of realtors as well. And a pleasure to be here this evening, Joe.
And you just learned about a whole new industry that you never knew about, the non-QM lending space where I'm at.
Right,
so,
exactly.
So I'm happy to enlighten you with the industry is only about 18 years old. So it's not like it only started really 2008. So it's not even 20 years old. It's a very newer industry where 1031's been around
so
a little longer.
1031s have been around for 100 years.
Yeah.
And what I'll be speaking about as well is a specific niche within the 1031 market, which is called a Delaware Statutory Trust. It's a mouthful, otherwise known as a DST, and they've been around for almost 40 years. So happy to get into that further as we discuss some of these items.
So I put some questions together that I felt that were just ones that really were just straight educational, just insight to what 1031 exchange and why should a real estate investor understand these items as they scale into the business, right? Everybody wants to scale, but they might sell something off, or they might not even know what the term is. So we'll start off real easy. What exactly is a 1031 exchange?
So a 1031 exchange is otherwise known as a couple of terms: a tax-deferred exchange or a like-kind exchange. It pertains specifically to investment real estate, commercial real estate, investment business real estate. So any type of real estate, and it could be real estate, whether it's a piece of land, a multifamily property, an industrial property. So various types of real estate. And again, it's referred to as a tax-deferred exchange or a like-kind exchange, whereby an investor who owns a property for a number of years, who's looking to sell the property, is going to experience a capital gain, and would have to pay taxes on if they exchange the property and reinvest the proceeds in a certain methodology. They could defer those taxes by doing a like-kind exchange. And we'll get into a little bit more details as far as how that process works, but that's the general concept. Is you own a piece of property, you've had it for a number of years, you're selling it. Before you sell it, you think about wanting to defer or save money in your taxes, and you could do that by completing a 1031 or a like-kind exchange.
So what qualifies as a like-kind of property?
So again, a like-kind property would be a property that's held for business use or investment use. And it could be any type of property as long as you're not living in the property. So it could be a rental property where you have individual tenants who live in an apartment building. Could be a two-family house, a four-family apartment building. Could be an industrial property where you have one tenant, a single net lease property perhaps, or any real estate holding that you have that's a non-residential property that you're personally living in or have family living in that property.
So what types of real estate do not qualify?
So actually the only real estate that would not qualify again is the home that you're living in. So your own residential property where you've lived in for any period of time and you may have a large gain when you sell that. There's other benefits that you might accrue, but that would not qualify one that you're personally living in.
So are there any, I mean, I know there's a lot of advancements going on with the current, government and past government, the last 4 or 5 years with 1031 exchange. What are the critical timelines investors must meet?
Right, so the critical timelines are effectively two, and you'll hear this from time to time, and just to put it in specific context, there are 45 days identification period and 180 days reinvestment period. So at the time that you're looking to sell the property at the closing, your clock begins to tick. When you sell the property, your proceeds goes to a third party. We'll get into that in a minute. But at that point in time, your 45 day begins to click, and during that period of time, you have the opportunity to identify your replacement property. So the property that you're selling is referred to as a relinquished property, and the new property that you're going to be buying or reinvesting in is called a replacement property. So during that first initial 45 days, you have to look around and identify one of these types of properties. And then within 180 days, which includes that first 45 days, you have to purchase one or more of those properties. And that effectively allows you to complete a 1031 exchange and defer the taxes until a future point in time.
Yeah, it's quite funny. You just brought something, memory of mine. I had owned a 4-unit mixed-use building in Easton, Pennsylvania. This is like my first property I bought on my own outside of my family's portfolio. It's probably in the mid to early 90s, and I held it for a bunch of years, did a lot of renovation to it. Then I put it up for sale, about 8 years later. And the realtor slipped and told my realtor that the gentleman identified the property as a 1031. And we stopped negotiating. It's this price or no price. Like they gave away basically the ACE card that I needed to know. So I didn't have to negotiate. I didn't give anything away because either I knew he was under a 45-day.
The clock, right, exactly.
The clock started for him. So if he didn't buy the property the way it was, I don't think the realtor that was the buying realtor really knew that he knew to reveal that. But again, that was really early on in the 1031. That was the first time I got exposed to 1031 exchange.
Yeah, that's a critical part of the strategy, obviously. And probably the worst calls that I get is that I've sold the property, I have the money, I want to do a 1031. Sorry, you can't take constructive receipt of the money. It has to go to a third party, which we'll get into in a minute. But that's another aspect. Or within that 45-day period, once you get close to the 45th day and the time's clicking, I get a call from somebody saying, I've got 2 days to identify because the property that I was looking at didn't pass muster, didn't pass my due diligence. Now what do I do? Well, there are options, and we'll discuss that in a little bit here, but those are other things to think about.
Yeah. So who's the qualified intermediary, and why are they required?
So qualified intermediary is just a group, or it could be an individual who is in the business of holding the proceeds for the investor before the reinvestment is made. There oftentimes could be a tax attorney, could be an accountant, knowledgeable about all the different details of a 1031, a transaction, because there could be a lot of layers to a transaction depending on how the property is owned, if it's an individual, if it's an LLC, if it's a partnership, tenants in common, the 1031 intermediary, otherwise known as a qualified intermediary or a QI or an accommodator. That's the group that holds the assets, the funds, before it's then dispersed to the to the next seller of the property, who's you are going to be buying your replacement property from.
So can improvements or construction be part of the 1031 exchange?
They can be. It's not my specific bailiwick as far as the details, but that's another aspect to, if you're in the part of the business where you are making improvements. I believe that there are certain costs that could be added to your cost basis, but I would defer that discussion to another day or another person who specializes in that.
No problem. So how is debt treated in a 1031 exchange? So if I come with 70% of the loan and the 1031 covers the other 30%, what if there's a little amount in there in the middle that's a little off?
Right. So it's a good question. The way the 1031 works, the replacement, is that you have to replace an equal to or greater amount of debt and equity. So if you own a property with, say, a 50% loan, 50% loan to value or LTV, that has to be duplicated in the replacement property. So if you have a 50% loan, when you sell, you're going to have to replace that in the next property that you buy. So you can have a loan on a property, or you may not have a loan, but again, the technical aspect is that you have to replace an equal to or greater amount of debt and equity. And you can accomplish that by, if you can't find a property going forward with the appropriate amount of debt, you can add cash to the transaction to make up the difference. But that's another consideration as you look for your properties, and another consideration as far as the timeline, because if you have to be approved and find the financing, all these things add up in terms of a real estate transaction. Again, on the face of it, 1031 is very straightforward. You're selling a property and you're replacing a property. You have 45 days to identify, 180 days to close, but there are different steps along the process that may make life more complicated for you.
I just closed too, and it was pretty seamless. I mean, we had all the documentation from the individual that played the intermediary. We had everything, and it was pretty smooth.
Yeah, it's like anything else in life. The better you plan,
Yeah.
the more smoothly it's going to go.
Yeah.
And if you have a tax attorney, or if you have an accountant, or some type of an advisor, it's good to clue them in on the process sooner than later, because they can provide advice, they can make introductions. I often work with any number of individuals that just helping make introductions, helping the process, because there could be other parties that come to bear.
Yeah. The best thing I did was I told the realtors just stay out of the way and allow me to talk with the attorney, the intermediary, and the lending side, and we were able to the realtors were CC'd on everything, but they just stayed out of the way.
Yeah.
And it all just went to the closing table in a seamless manner. So my next question would be, what is boot? How does it affect tax deferral?
Yeah, boot refers back to our conversation just a minute ago, is the amount of money that may not be replaced in a transaction, or if you take money out of a transaction, it would be taxable. So it's literally the amount that is taxed. It could be, if you don't do a replacement with a sufficient amount of debt or equity, you then result in boot, which is then taxable. It doesn't give you the full benefit of a 1031. Now, having said that, you can do a 1031 that where you're not replacing all the debt and equity. Some people choose to do a partial exchange, in which case they're taking out some cash at the closing and that they're not fully reinvesting, and that cash would be taxed. So there are different nuances in terms of how you do the 1031 transaction, but to benefit from a full, complete 1031, as I mentioned, you've got to replace an equal to a greater amount of debt and equity. Otherwise, you have a boot situation, which is a taxable event.
So can you exchange multiple properties for one or vice versa?
Yes. So you can exchange one for three or three for one. You can, it's an option where you, it just refers to the amount that is the key aspect of the 1031. As I mentioned, the overall proceeds, but it's reinvesting and keeping in mind both the debt and equity. And again, as I talked about before, a like-kind exchange or a 1031 does not mean if someone comes up to me and they have a two-family house that they're selling or an industrial building, they don't have to reinvest in another two-family house or another industrial building. They could sell a piece of land and invest in an apartment building, or they could sell an apartment building and invest in a piece of land, a farm, what have you. So as long as it's real estate for real estate, like-kind exchange, it could be any, as we say in the business, any food type across the board, student housing, land, multifamily, industrial, what have you.
So this is a question within a question, because the next question kind of ties into the LLC side. But if the property's in the name of the personal name, it has to, that 1031 has to go to a personal name.
Right.
If the name of the selling property is in an LLC, it has to stay in that LLC to the next property.
Right.
Okay, so nothing, you can't break that chain of command.
Yeah, that's where where you want to have good advisors, knowledgeable people that are working with you, which usually comes down to the qualified intermediary. They will be the person among those involved, those parties that know what actually works. Because Joe raises a good question. If you're selling a piece of property in a certain ownership structure and you want to have a partner involved, or if you have a partner and he or she is not going to be involved going forward, they don't want to participate in the 1031, it creates more complications. Certain of these aspects can be dealt with, but again, it goes back to planning. And the earlier you begin the planning process, the better. But as you mentioned, Joe, it's got to go from A to A, B to B, not B to C and D. There's a very strict methodology in terms of the process.
Now, irony enough, non-QM now allows loans to close in the personal name and or the LLC. So it's not like a problem anymore. Like a couple years ago, the non-QM industry has evolved along with 1031 exchange because of these circumstances. Like in the state of Pennsylvania, transfer tax just alone is 4%. In the city of Philadelphia, if you want to refinance the property in your personal name to an LLC, the 1031 exchange, same thing here. If it's in your personal name, it has to go to the personal name. It can't go to the LLC. So non-QM has changed in the industry a little bit based upon 1031 exchanges. This is something recent in the last 24 to 36 months.
Right. The other interesting thing you mentioned, since you mentioned Pennsylvania, I moved to Pennsylvania about 4 years ago from Connecticut. And early on when I was speaking to people in Pennsylvania about 1031s, they would say, oh, I don't think you could do a 1031 in Pennsylvania, or is that allowed? Well, of course it's allowed. There's a benefit, a tax benefit, which is at a federal level, but also all states up until recently, except for Pennsylvania, Pennsylvania didn't allow that tax benefit. I believe it was about 2 years ago. It finally changed to allow it, but that it doesn't mean that in the past you could not do a 1031 in Pennsylvania. Of course you could, but you only got the benefit at the federal tax level, not the state. Now you get both.
So things are evolving with a lot of these industries. Like non-QM is waking up to a lot of. It's becoming a very chameleon-like industry where the banking industry can't because they're regulated. So remember that the difference between a banking industry type of environment, it's regulated. If it's non-QM, it follows guidelines. Not that it can do, stuff that's off the wall. They follow guidelines. It's just different. Just think about a boxing match. There's a boxing match where you're wearing gloves, and then there's a boxing match when it's just bare fist. So non-QM is a little more bare fist comparatively to the gloved. That's all it is. But
and since we're using different acronyms, I'll be using a couple. Again, just remind me again, Joe, the QM that you're referring to?
Non-qualifying mortgage, where they're not looking at tax returns, they're not looking at W-2s, 1099s, pay stubs. They're looking strictly at the asset, whether it's in the personal name or the LLC. It has to be a non-owner occupied property because you can't finance anything on the owner occupied side because that's RICO.
Okay.
RICO laws kind of come into play. So you got to be very cautious about that because you don't want to be touching anything that's owner occupied, nor do you. And you got to make it very crystal clear because some people just don't pay attention, and then you find it a little too late, and all of a sudden you're in the middle of this. You think you're in the middle of something, and it kind of blows up. So you want to ask all those questions before you bring in experts such as Mark, because it can get hairy real quick. Is it in the personal name? Is it in the LLC? Is there a partnership? Is there are they coming along for the ride to the next property?
Right.
Are you 100% owner of that LLC? Is there any minority interest, and who are they? Or what are they? It could be another entity. So it all has a lot of moving parts. That all has to be very clear, I think, for both of us.
Yes, exactly.
Because of what we're doing. Because for me, I'm not collecting tax returns. So I'm getting an appraisal. I'm doing a soft pull on the client. Any non-QM lender is doing that. And they're looking at the transition of that money coming over as the down payment, okay? And I have to match it up with a debt piece if the 1031 doesn't take in the whole loan. Mm-hmm. So there's more discussion than just a couple emails, I think.
Right.
And you really want to work with somebody that has transactional experience with this because we've made enough mistakes to balance out our successes. Is that a fair assessment?
No, exactly. And I would also say to that point that like any other transaction or anything you do in business, the experience quotient is critical because even if you have an accountant or an attorney or a realtor, they may not be that familiar with the 1031. 1031 is pretty straightforward. However, it's not something that many accountants deal with on a day-to-day basis, or attorneys. I've done a number of continuing education classes, as has Joe, with accountants and attorneys, because if you're a certain kind of a corporate attorney, even a real estate attorney, or a corporate attorney, this is a particular niche, and it just is good to have resources to pull in to make sure you've got an effective, successful transaction.
So I have two more questions I feel that are important for our audience this evening. How do 1031 exchanges interact with estate planning? So, because, I'll give you an example. I have real estate holdings up in North Jersey.
Yeah.
Okay. There is no third generation. Right. So eventually I have to talk to somebody to figure out that lessen the burden of the tax impact for somebody down the road. So, you can only kick the can so far, but at least for my lifetime, I own X amount of buildings, and I don't want to hold them forever. Mm-hmm. There's going to be a certain point where I get tired of doing that. So from an estate planning, I'm probably about 10 years out, right? But I should start setting the tracks now. So somebody like myself or somebody scaling up their real estate portfolio, how do 1031 exchanges interact with that?
That's a good question, because people will refer to 1031s as kicking the can down the road, or you keep doing a 1031, or they may refer to a swap till you drop. And then at that point in time, you're no longer around. So
Yeah, you're nothing to win.
you're not paying taxes, but maybe someone is, but they're getting a step up in their basis, so that they're effectively they wouldn't be getting it. So with the 1031, you find out in a lot of businesses where people our age or our parents' age have done a lot of work assembling a portfolio of real estate, and their kids may have helped along the way, but at some point in time, they don't want to deal with their parents' portfolio or what have you. They're off doing their own career, that maybe they're in the arts or what have you. So it's something to consider, and that's where you need, planning, estate planning. And so one of the areas that I do specifically is I work with many real estate investors who are older, who are selling a piece of property, and they personally have assembled properties, but they no longer want to deal with all the management headaches, the property management headaches, as some people are willing to do at a younger age. And so we refer to it as toilets, tenants, and trash. They want to sell a piece of property, book the gain, and defer the taxes. And they could do that in a 1031 by doing an investment in a passive vehicle, which is what I work with specifically with a lot of investors, because as I stated up front, I'm a securities representative, and there's a securities entity, a structure called a Delaware Statutory Trust, or a DST. We're doing it using a number of acronyms, QMs, QIs, now a DST, a Delaware Statutory Trust. It's a mouthful, but it basically is just a passive entity. All of us here in the room, we're selling a piece of property individually, $500,000, $1 million, $2 million. We all decide we want to defer the taxes. We then co-invest with a sponsor or an entity that buys a property or portfolio properties. We roll in our proceeds, and then we're pro rata owners of this property through this vehicle called the Delaware Statutory Trust. And then we receive income from the property. That's what real estate is about, rental income. And then when the property is ultimately sold, we receive a pro rata share, and we could go our own way or have that entity be gifted to one of our beneficiaries. And then another option, which happens occasionally, is something called a 721 transaction or an UPREIT, where an interest in one of these DSTs could potentially be uprooted into a real estate investment trust, if that's an option. The sponsor who creates the DST may have a parallel portfolio of real estate through a real estate investment trust, where when the DST's property is sold, the individual can take their money, pay their taxes, do another 1031, or if they're given an offer to have that ownership interest rolled up into the real estate investment trust, that's a possibility also. It's called a 721 transaction or an UPREIT, which then specifically helps the estate planning as well, because then you have shares in a corporation or a real estate investment trust, which you can then divide amongst the family, and they could sell it at some future point in time should they wish to, and once the REIT is a public entity.
So my final question, before we open up to some questions with our audience members, what's the outlook for 1031 exchanges in 2026 and beyond?
I think they're very bright. I mean, given what's going on in the economy, the growth of different real estate sectors, the recent tax bill, the legislation, there's growing need for various property types. I mean, as we know, we have a need for housing in this country. And so there's multifamily properties that are coming on stream more so. There's a need for energy in this country. There's data centers that are being built. Those are potential 1031s as well. I mean, you can sell a piece of land and reinvest your proceeds in a data center, perhaps, or an industrial property or a medical property or student housing. So again, benefit is to consider diversification, which helps to limit your risk, diversifying by property type, by geography, and those are other considerations. But I would say, given the economy and the need for opportunities for people to diversify. It's the 1031 industry it's been growing and continues to do so, and as well that other area that I mentioned, the Delaware statutory trust. And I'll finally mention there's been another benefit for real estate sellers or owners to defer their taxes through yet another entity, and perhaps the subject of our next get-together, Joe, is in something called a qualified opportunity zone investments, which is yet another way that people can reinvest proceeds, defer taxes, and potentially save money on their profit down the road.
Excellent. I really appreciate this. Nick, do you have a question maybe for Mark or a statement?
Can you talk more about the debt and equity current process? So if I were to flip a property and then 1031 into the next investment property, you said the debt and the equity has to match to the next replacement property. Can you give a tangible example of something simple to follow?
Yeah, just so if you're selling a property for $500,000 that you have a profit on, and you have a $300,000 mortgage, that's a 60% debt to equity, or loan to value, I should say. So on the next property, you have to have at least a 60% loan on that property. It could be more, but it cannot be less. Both mortgage has to be more and the equal to or greater, as well as the equity. And that again goes back to the question of planning and securing your financing, your mortgage. So those are all things to consider. And then with the other strategy that I mentioned, the Delaware statutory trusts, those are typically syndicated transactions that are put together by a sponsor that will have debt in place. So if you need that 50% debt to equity, LTV requirement, that would be built into the structure of that offering. And that, by the way, would be on a non-recourse basis. So that's yet another advantage for an investor who's considering that option. And it could be part of a transaction too. Again, this DST as either as a backup or as part of a larger transaction. If you're selling a piece of property and the property that you're going to be buying is not equal to or greater, you can add a DST investment to make up that difference to avoid the boot in that example.
Excellent. Do you have a question for Mark?
Yeah. So, is there a cap for these 1031 exchanges? For example, my company currently owns a building which is worth 600 million. So, can my company sell it to someone or some other corporate company for size of this building and use this exchange?
Sure. Yeah. There
doesn't matter the value.
No, the values could be, extremely large, and yeah.
But okay, it works at a corporate level as well,
right?
Not just personal.
Yes.
Just one more question I had, and this exchange also works across state. Like I have a property in Pennsylvania and I want to sell it here and then buy another property in Texas. Does that work? And if so, then how does the state benefit apply then?
Well, you're just, so the question is can I sell a property in Pennsylvania and reinvest in Texas? Yes, you can, as long as it's done within the United States. The IRS allows you to benefit from a 1031 transaction or like-kind exchange. And the way it works as far as taxes is concerned is that you're just saving or deferring your taxes that's owed to, obviously, the government, Uncle Sam, as well as the state. And then in the future, when you sell it in that state, then the state taxes would apply if you did not do a 1031.
Okay. So right now, if the property is based in Pennsylvania, then the taxes that I will be paying will be from Pennsylvania.
If you were not to do a 1031, correct? Yeah.
Good. You good? You guys are good? Do you have a question or statement for Mark?
In real estate over the years, what do you believe is the best investment, like single family, multi-family, apartment, commercial?
It's hard to say what the best one would be. So you've got different compensating factors. With a multifamily, you have a number of tenants. So if one tenant leaves, that's not as much of an issue,
Yeah.
right? But you have a number of tenants that you have to deal with. Likewise, those number of tenants who are leaving from time to time, you have an opportunity to continue to raise rents along the way after they leave after 6 months, a year, what have you. So it helps to keep pace with inflation potentially through multifamily. It's considered typically one of the best inflation hedges, as opposed to perhaps if you have an industrial building with one tenant, albeit a good tenant, they're paying one specific rent to you over a period of time. There's typically escalations in the rent, but oftentimes that property is known as a net lease property or a triple net lease property, and you have a fixed rental lease agreement, but it may have periodic increases over time. So that type of real estate acts more like a bond potentially. But so again, depending on your wherewithal, the time that you have to invest in real estate, deal with tenants, the amount of money that you're investing in, whether you're investing alone or with partners. I think those are all factors to consider. But I think, judging from the audience that we're looking at, the younger you start, the better.
Well, I'm going to add one thing to Mark, and I think you would agree with this. And I learned this from one of my mentors who's retired. Okay, so you eat an elephant one bite at a time, right? So whether it's a single family or a 2 through 4 or a 5+ unit, work that property, whatever it is, make it work, go to the next one. Don't try to do 100 things at the same time. It's very exciting at being under 30. I remember it. We remember it. But what we do remember is we try to take on too much when we were younger, and sometimes we failed, and sometimes we had successes, and probably had more failures. We learned from those, and thankfully we got to our age in one piece. So really just get your LLC set up, keep your credit above where it needs to be, which we know what needs to be. It needs to be 700 or better to be a really strong candidate for anything. And then start coming to educational subject matters like this to build your pie of experts. Because you don't want to be the smartest guy in the room. Does that make sense?
Yeah.
If you're the smartest guy in the room, you're in the wrong room. I'm going to guarantee you that. Is that a good assessment?
That's great.
Young gentleman?
My question would be, what market conditions make the 1031 exchange riskier or smarter?
Riskier or
Smarter.
smarter?
Like what the pros and cons to like market trends. Like we're in a kind of a very stagnant market right now, tight inventory. Is it better when it's a buyer's market or better than a seller's market with the 1031 exchange?
Well, it's a good question because real estate is local. It's not national, so it could be strong in Philadelphia, it could be weak in Arizona, or vice versa. So again, it really depends on where you are, what your circumstances are too. Sometimes other factors drive the transaction. If you have a business, you own a pizza place, and you get, or if you own a car wash, and you're offered a good takeover price because a private equity firm wants cash flow, and it happens during a relatively weaker market, you're not really affected by the outside market as much as you have a transaction. It came to you and it happens. So sometimes that's the only thing that drives it. Otherwise, I mean, certainly certain types of trends are in place where markets are stronger than others and people are bidding up real estate. But it could be just by virtue of that particular point in time is your lucky day and you get an offer.
Just one additional thoughts to that question. I definitely would not just hone in on urban settings like Philadelphia or New York City or Chicago or the inner cities I'd look at also the surrounding suburbs of those markets to see what's being impacted, or even some subsidiary markets. So like we're in Philadelphia, right? How is Delaware being impacted because of Philadelphia right now? Do you know? That's something to research. because maybe Delaware's a better barrier of entry for you, right? It might not be. Maybe Cumberland and Salem and Atlantic County might be a better play for you versus West Philly and or Northwest Philly or North Philly or South Philly. It all depends on where you feel comfortable you could build out that team of experts to succeed on that asset. Does that make sense?
Yes.
Your question?
So if there were a situation where taking partial makes more financial sense, full throw.
A partial.
Again, it depends. The question is, does it make some sense to do a partial exchange versus a full exchange? It certainly isn't the best overall tax benefit, generally speaking, but if you need the cash, you need the cash. And that may be the circumstances that drive the transaction. But I wouldn't say that I can think of a reason where that makes sense more so than doing a full deferral. The purpose of a 1031 is to defer the taxes and continue to build your portfolio. And that's what it does, because you just continue to add more real estate, whether you're using debt or doing it on an all cash basis.
Some great questions.
Yeah.
So I was really happy. So no, I want to thank you for making it out for tonight. This
Thank
was
you for having me.
I like this intimate type of setting where we can get really some good education out in front of people.
Right.
How is a good way to get in touch with you? If somebody's take a look at this, or some of our audience here, how do they reach out to you to have a consultation?
Yeah, probably the best way. I have a website, which is my group's called Net Lease 1031. The website is NL1031.com. That's the website. And then my phone number is 917-692-8282. It's a very easy number to remember for those of you who, other than the 917-692 spells out NYC, 8282 is LALA. It just happens to be that way. So an easy way to remember, 917-692-8282. And again, my website is NL, as in Nancy Lewis, 1031.com.
Well, Mark, I want to thank you for coming out to Real Estate Mastermind Strategies here in Philadelphia. I think this was a great discussion. Look forward to having you here in Lehigh Valley in Bethlehem.
Yes.
On Wednesday night at 6:30 p.m. I feel that you're now part of our team of experts. We could share you out to our group of network of real estate investors throughout the greater Philadelphia and Northeast region. And thank you, staying committed to stay in touch.
Absolutely.
I really appreciate it. I want to thank everybody for tuning in this evening. My name is Joe Scarice. I'm a nationwide direct private lender with Lend Investor Capital. I'm a regional vice president of sales. But I'm here really to make sure that you're walking away with value, connection, strategy. And that's really what we're trying to do here at the Real Estate Mastermind Strategies groups here every month. So stay tuned, stay in touch. And if I could be of any assistance, please reach out to me at any time at 215-290-5108. And thank you again.